In today's video, I am going to be breaking down some of my favorite covered call ETFs here in Canada. These are amazing ETFs that will pay you extremely high dividends. And so yeah, let's just get down. Let's check these out. I absolutely adore some, but not all, covered call ETFs. So this first one is the CI Healthcare Giants Covered Call ETF. It goes by FHI on the stock market. From there, what we want to look at is some of the volume, because how easy or how hard will it be to get in and out of this ETF? So, as we can see, it is an $11 ETF, so you should see some pretty high volume. However, you're only seeing an average volume of around 9,000 shares traded per day. So that tells us that somewhere in around $100,000 is being bought or sold of this ETF every single day, which is not a heck of a lot. Which means that if you're looking to invest $30,000, $40,000, $50,000 into this ETF, it is going to be extremely hard to get out of it. However, the dividend is ridiculously good at 9.83%. Its expense ratio, the MER, is essentially the same as all of the other covered call ETFs, which is 0.72. And it's not a very old ETF, but we can see that it does vary in its range. And if we really draw a straight line, it has finally broken past its high points from before, and this could mean that potentially that it has some room to run, but that's, again, speculative if you really think about it whenever you're trying to read charts. It does pay a quarterly dividend, and the quarterly dividend is actually pretty good. If you think about it, it's pretty solid. It's been going up. If we see March over March, it goes down. However, if we see June over June, we see that it was a massive raise. And then if we go from March of 2020 to March of 2021, there was a raise again. So this is a good sign into the future. These are the companies that it does hold, and out of its top 10 companies, it has a 52% weighting, which means that if any of these top 10 companies have some negative news, don't expect there to be a great time for this ETF. However, you are getting that ridiculous, massive dividend that will allow you to withstand some of those down times. This next one is a BMO high dividend covered call, which is ZWC on the stock market and is classified as one of the best high dividend covered call ETFs in Canada. I think I was reading an article saying that it was the biggest. It is currently at a 7.5% dividend yield, and its average volume is 232,000 shares traded every single day at $18 a share, meaning you're probably going to be fine getting in and out of this ETF if you wanted to sell one day. Even if you had $50,000 worth to sell of this ETF, you would be totally fine. Now, over from the beginning of starting this ETF back in 2017, it did trend downwards, which is quite concerning. However, recently it has had a nice growth spurt, but also something about covered calls is, and of course the Canadian market is, we weren't having that great of a time during that period anyways, unless you were in some different tech stocks or other growth stocks. But the market as a whole didn't really move all that much. It does pay an 11-cent dividend every single month, which is something that I do really like, and it has raised its dividend over time. Its largest holdings is, of course, the banks: Royal Bank of Canada, TD, Bank of Nova Scotia, CIBC, Bank of Montreal, and then it does have oil companies as well, and Enbridge, even though it's more of a oil shipping company, it's still classified in my books and many others as an oil company. And then there's telecommunications, there's also insurance companies, there's a lot here. Next is the BMO Covered Call Technology ETF ZWT on the stock market. Now this one is a lot newer, so there's a lot of speculation that we would put towards this ETF. Even though here it says not applicable for the yield, it's just because it's a new ETF. So we can kind of guess from when it was created until now. It does pay a monthly dividend, and it's about 5% from my math. Now, it does only trade at 4,500 shares per day, which is not huge, so it may be a bit hard to get out of it. And it does tend to trade within a range, but again, we're only talking about less than a year. We're literally talking about less than a couple of months, really. It's like the end of January is when it started. And this is what I mean by the dividend. It's paying 13 cents. So if you go 13 cents times 12 divided by 31, then you're getting around 5% dividend. See what I mean by speculation, though? We've only seen 4 months of dividends: February, March, April, May. June will be coming up soon. And if it does come up and they keep on paying 13 cents, that's still showing into the future 5%. Will we see more of a dividend? It's hard to say. However, they are holding a lot of stocks that are very heavily used in the options market. Facebook, Google, Microsoft, Amazon, Apple, Visa, MasterCard, Nvidia, PayPal, and Adobe are all very big stocks. There are better tech ETF covered calls out there like TXF, which has a longer, larger history. And this is what I mean by it. That last ETF may have a bigger yield into the future, because we can see from this ETF that it's got an 11.5% dividend, which is huge, massive. It does have 55,000 shares traded on average every single day. Its expense ratio is again in that 0.7 range. They're all going to be like that. Over the past 5 years, we can see that it does have growth, some stagnation, almost like a double bottom here, almost. And then also some growth. Now we're seeing this growth kind of wave off into potentially a stagnated time, which would not be surprising after this kind of growth. But it's always good to get in on these things when it starts stagnating. Get it near the bottom, sell it near the top if you wanted to do it that way. Or what you can do is try to buy it just under $20 over and over again until it starts breaking through that $21 range, and that's when you hold it until it starts coming back down again. Now, as we can see, it's not like the last one where it doesn't give you a monthly dividend, it gives you a quarterly dividend. It does tend to change every quarter, so that's my reasoning behind liking the BMO version of this. However, at the same time, the fact that the dividend here is double is a lot more promising in my opinion. This one does hold a different bundle of stocks in a way, at least in a different weighting. So we're looking at Nvidia number 1, being then followed by Google, Applied Materials, Adobe, Amazon, Facebook, Oracle, Apple, IBM, and then Microsoft. And then this next one is the Dow Jones covered call. Now this is, even though it's a lower yield, this is actually one of my most favorites. So this one only does give a 4.6% dividend. Its average volume is 7,300. I personally own this one. I own a lot of these actually, but again, MER is 0.72. No big surprise there. The chart is what I really do like. So we can see growth, a little bit of stagnation, and then massive growth again. I like to see the growth. I like to see the stagnation. The stagnation shows to me that it's not going to be crazy. I like stagnation. I'm one of those weird investors that like this period, because that gives us a time to get in and then be able to see what the market is going to do afterwards. Now, of course, when it tanks like this, you generally don't want to sell. What you want to do is buy every time it comes down, and that way you can gain on that growth. This one does pay a 10% dividend, but as we can see from farther down, it does tend to raise its dividend every once in a while, but not very often. And these are its largest holdings. My favorites out of all of these is Home Depot, Goldman Sachs, because it's a bank and I absolutely love banks, and Caterpillar, because I think we're going to go into a massive growth period when it comes to economics. Anyways, these are my picks for my favorite covered calls. Let me know what your opinions are on these down in the description below. Go check out my favorite investing books down in the description, and I will see you guys in my next video.